Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. I'm so fortunate that I get a chance to talk to some of the most amazing people in the world and learn myself, and hopefully these have been valuable for many of you as well. To give a little bit of context to the conversations that I have, I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail during times of crisis. Today's conversation is titled Negotiating Terms When Investing in Private Companies. It's all in the details. It features Travis Leach, partner at DLA Piper. We all know that investing in private companies is a tremendous trend among ultra high net worth investors and family offices. And we know the reasons why. It's a less efficient market than the public markets. Henceforth, knowledge and the right decisions could potentially get outsized returns. It's the opportunity to understand the inner workings of a business to help educate the next generation, much more hands-on than investing in public companies. And a big one, and maybe the biggest one, sometimes even ahead of potential greater returns, is control. Now, depending on what position you come in on as an investor, but that opportunity at minimum to potentially control your position to get in and to get out is often very, very important for families. We're a little more challenged now during COVID, but I think a lot of investors and a lot of companies have adapted. So we're very fortunate to have Travis on today. I've known him for approximately a year. He's very senior at DLA Piper and has been a wonderful resource in angel and VC and direct investing. Today, we're going to be more focused on, as I noted, the negotiating terms aspect, which is something in my what feels like hundreds of these since COVID-19. We've covered a lot on earlier stage in VC, but I don't think we've done anything on negotiating terms. So what we're going to do with Travis, because I think it's important to lay a strong foundation, is I'm going to give the floor to him in about 20 more seconds. He's going to give a brief overview of himself, and he's going to give what I call a mini presentation on that subject. It'll be approximately 20 minutes. I then have questions I'm going to want to ask him, and we have a live audience that through the chat feature will likely be engaging and asking questions as well. On that note, Travis, welcome to the program.
Great. Thanks, Angelo. Thanks for having me. Quick background on myself. I'll go through it quickly for those who may have heard it before. I'm a partner at DLA Piper and head of our private equity and venture capital practices, and help to a subset of our private equity group is working with family offices. And we started that practice 3 years ago to do exactly what Angelo focused on, is what we saw as a direct increase in investments by family offices and in going through the VC PE style investments that are so well talked about. So we thought we'd expand that practice and focus on working with family offices. And that's what led me to meet Angelo and come out to some of these events, and hopefully I've met a lot of you there. The biggest issue we see in working with our clients, and Angelo, I think, teed it up well in terms of negotiating terms and what issue. I think the first thing that I'd like to highlight is diligence. And Angelo and I had an interesting conversation before this call started. How much diligence is appropriate for a family office or a direct investor? And that's really for the investor to determine. There might be business reasons why a investment in detailed diligence doesn't make sense. But where we've seen a lot of issues come up is understanding the business risk and legal risk in the investment. I think a lot of our clients, both PE, VC, and family office, have very good financial folks internally. So they're able to analyze the financial statements, look through the company records, and determine if this business is being run the way that has been explained to them, and they can get comfortable with it from a financial side. Where we've seen the weakness, frankly, is on the legal. And again, it's a business question to ask internally. how much do you want to invest in personal capital, personnel, looking at things and going through documents and spending that time, or handing that off to an outside service provider and obviously paying the fees that go with it. So it is kind of a constant push and pull, but really comes down to your individual assessment of the risk. But what we've seen, again, is that our clients have been very comfortable on understanding the financials, but it's been a weakness in the legal due diligence. In the example I've given a few times at some of Angelo's events, I work with a very well-known national family office, and they just recently, within the last 2 years, started allocating a significant amount of their portfolio to VC style investments, early stage, outside of their historical comfort zone. It's a consumer goods family office. And they're looking at tech and things that are just historically outside of their wheelhouse. And again, they can analyze the financial aspects of that, but where we've seen a little bit of them getting up to speed is on the legal. And the example I've given is when we got documents in this deal as kind of a final sign off, let DLA look at it, make sure we saw no issues. We saw a number of just basic typos in the documents, a number of things that didn't tie together. The cap table was incomplete and off. So you can imagine at the very end, when they've got comfortable with the risks from the financial side, all of a sudden we started raising all these legal issues that frankly the lead investor should have caught, but everyone was really careful on the allocation of personal manpower and legal expenses. And our investor client that had the resources to spend money on legal discovered all these issues and had to go back to the lead investor, and we needed to revise the documents. Was not I think it was really just sloppiness on both the company's part and the lead investor. But again, these items needed to be completed before the deal closed because it impacted the cap table and where what percentage of equity our client had. So again, a little bit of a value that we provided, but I think more goes to the question of, as a direct investor, how much time and resources do you want to allocate to diligence? Because to me, that is the most important thing. Moving on from the diligence, it's what terms, in the title of this presentation, devil in the details, what terms are the investors seeking? And Angelo and I've, chatted about a few laundry list items, but is there any aspect of business control that the investor is looking for? Does it want a board seat? Does it want to actively serve on a board? The question, that answer may be no. They may not want the liability or exposure of being on a board, or they may want some control in having a window into the management of the business. So I think that is a initial first question to ask. After control, the standard set of terms, and a good resource for everyone that's not familiar with it are the NVCA forms, so National Venture Capital Association forms. So any company or family office or VC that is looking to do an early stage investment, we always recommend looking at the NVCA forms, and you can go right onto their website and pull down a standard term sheet, standard documents in the venture capital market that will run through these standard sets of issues. So control, rights as an investor, what sort of investor protections would you like? What sort of preferences on your investment, if any, would you like? And these forms run through that, and it's a great resource. And you can know that if you present these forms, the company and any counsel will look at them as a market position. So it's really running through the analysis of what you'd like to ask for, and a lot of that's dictated based on the financial, I guess, risk or investment that you're looking to make. Obviously, the larger investment or the chunk of the fundraise, if you're looking at taking that down, you'll have more leverage clearly than a smaller position. So some of those issues may just be dictated on that. Angelo, I don't know if this is a good time to go through some initial questions or.
Sure. No, that makes sense. It's just so much. I'm almost wondering where to start.
I know. That's why I wanted to make sure we had time, because sometimes reacting to some of the questions you may have can help me dive through, and I'm happy to answer any questions from.
Yeah. Now, so much of this varies. Like, am I more of an earlier stage angel / VC investor, and I'm investing in a deep tech company and putting in just a modest amount of money, 50 or 100,000? Or is this more a classic business that most traditional family offices will invest in, that are more of a PE type investment, that are probably already producing cash flow, maybe a little bit distressed, so it's an opportunity? Let's start with the first one. It's an earlier stage company. We all saw the Social Network movie. We know what happened with Eduardo Severin and Mark Zuckerberg and Peter Thiel's interaction with his legal people. We know Eduardo signed things without looking at them, but basically he got incredibly diluted. Now, he ended up taking some things to court. There was a settlement, and he's a multi-billionaire living in Singapore, so we are not feeling sorry for him. Mark Zuckerberg put the heavy lifting in there. We all get it. But the concept of, if I'm investing earlier stage, I'm assuming through A, B, and C and D rounds, if needed, I probably am going to get diluted. What could I do to have options to at least buy in at the new valuation or higher price so I could keep my percentage?
Yeah, great question. So again, I think, so the overarching, I keep hitting on this, is diligence. So as a early stage direct investor, understanding the cap table, understanding any risks out there. So, you can ask the company to represent how many shares are outstanding. Are there any disputes with founders? All of those things should come up in the initial diligence process and are important questions to ask. And it may get redundant, the amount of investments that a family office or early stage investor make, but to just run through that standard diligence Q&A to understand those outstanding risks. Now, things you can ask for, Angelo, kind of turning to that, you certainly, it would be very market to ask for a right of first refusal on any future investment. If I invest X dollars to get X% of the company, I would like to have the right to purchase that pro rata amount in any future investment or offering by the company. And that allows you to keep your percentage. And it also gives the company or investor the discretion on whether or not it wants to put further dollars at risk. So I think that is the easiest. Now, we've seen dilution protection for an early stage investor, pretty uncommon, but for a company that needs the money and the investor arrives at the right time, you might be able to get dilution protection, which would essentially say, I'm going to put X dollars in for X% of the company, and under no circumstances will I be diluted under Y%, no matter what. And you've got to come to me to ask for approval to do that. We've seen that. That's a little more rare.
And whether it's an earlier stage company or a little bit more what appears to be a direct investment into more of a private equity type traditional family office play, again, the devil is in the details. If I'm looking to make an investment in that company, besides the cap table, the corporate structure, the outstanding shares that you noted, how about things like, well, what type of shares? Are they preferred shares? Are they voting? Are they non-voting? There's lots of moving parts here. Again, we can't make it a 3-hour negotiating and diligence meeting, but if you could give us a little bit of a recap of some of the more common type of ways that an investor would invest in a private company, taking into account the things I said on voting, not voting, preferred, et cetera.
Sure. So high level, again, all of these, this is really investor preference. But what we've seen for early stage companies, it oftentimes it'll be a convertible note. And the reason to do a convertible note is the investor would have priority as a creditor in the event the company fails or liquidates. So you would have priority over equity holders. So you are looked at as a creditor, having preference over equity holders. Again, that assumes there's assets to distribute, but it's a relatively common structure for early stage. So again, seeing it as a convertible note, the note converts either on a threshold level of financing. So the note would automatically convert at a predetermined capital raise. So for example, you may invest $1 million, and as a convertible note, you receive a small interest payment on that convertible note. And upon an event, let's say a capital raise of $10 million, that note automatically converts into equity. And and then you have then your equity holdings. There are other convertible features that could be optional, but that's one thing, that's one structure we see, Angela. Another is a direct investment for equity, and depending on the note may not be an interesting feature to certain investors. They may want to come right in as an equity holder. So we have seen that. I don't know, Angelo, is there other aspects of that question I should touch on?
Yes. So I'm assuming it's possible in the corporate structure. I'm just using this as an example. Let's say that someone wants to raise a lot of money, is willing to give away a decent percentage of the company. They could have non-voting at 98%. They could own, and again, a rare example, I'm just bringing it up. They could own 2% of the company. I would wonder about their skin in the game. I get it. But in theory, suppose that 2% is all voting. They have complete control. Now, if I was a family, that probably doesn't sound like such a great deal for me. But are these things that you see? And what's the word I'm looking for? Do some owners try to pull the wool over less astute investors' eyes on things like that?
Yeah, I think that's right. And I'm glad you raised that. I knew there was the elephant that I was missing, which is voting control. No, definitely that's something that is a push and pull on every investment. And it really comes down to what's important to the investor. So if the investor is looking for, let's say, if the investor is looking for some say on certain events, and we'll call those major decisions. So what might be common in operating agreements or company documents that you review is certain investors or classes of equity may have control over certain major decisions. Those major decisions might be, buying and selling of assets, incurring debt above a certain threshold, merging with a business, certain things that we decide are significant to the company, and the investor may have a say on those. And how you split that is the investor itself could have an approval right. So regardless of what the percentage ownership the investor has in the company, it may itself be able, regardless again of how much it holds. It could be 2%, it could be 51%, but the negotiated term is it has a say on those matters. It could also be the class may vote on those matters, or it may have no vote at all and be non-voting. Those are all things that come out in the diligence process. And really for us, it's what's important to our client, the investor, and what do we need to put for. We may ask for everything in the beginning and then just focus on a few key things. But the key takeaway is really to read the documents, because a founder may have control, to Angelo's point, no matter what the percentage ownership it has. The class of equity that the founder has may be superior and may hold all the voting rights. So it's the importance of reading what the documents require.
And actually, on that note, what are those documents? So again, every situation may be different, but I'm assuming it is the corporate structure, C Corp, S Corp, LLC, in that document, a cap table, so you know who's an equity holder and their percentages and what their valuation, for lack of a better word. But I'm assuming in the case where there's going to be an investment, there probably is some type of operating agreement and maybe some other documents. I don't know if they have a specific name, but maybe you could bring up some of the more common documents and describe a little bit of what they mean.
Right. With an LLC, so if the investor is investing in an LLC, the answer is pretty easy. It would just be that limited liability company agreement. That should be the document that contains all of these relevant provisions. So it's a little easier. For a C Corp or S Corp investment, there are usually a number of documents. You'd want to see the certificate of incorporation, the bylaws, a stockholders agreement. Those would be the key documents. And then in addition, there might be an investor rights agreement or voting rights agreement, oftentimes a separate right of first refusal or co-sale agreement. But all of that would be under the umbrella of governing documents. So the easiest thing to do is ask for all of the governing documents, and you should get that set, whether it be just the limited liability company agreement in the case of the LLC, or maybe the set of 3 to 4 other documents in the case of a corporation.
You hinted at it earlier, but maybe give a description of what's called blocking rights.
Blocking rights. So, and I think this is, you can call them different things, but a blocking right would be, in what we would see in a term sheet would be protection rights. So what sort of rights do the investors have to protect their investment? And that could be a vote or veto on major decisions. And those major decisions can be anything from 2 or 3 items to 10 or 11. And they're usually highly negotiated, but they typically involve you can't issue more equity without our approval. You can't issue a superior class of equity without our approval. That goes to dilution. It could include you cannot merge or buy and sell assets. You cannot incur debt above a certain threshold. So there's a number of items that you can include there, but think of things that would impact your financial investment.
And I guess that I'm simplifying it too much, but you could either have minority investment or majority. I think if it's minority, you may want to have some issues of controls, but effectively, it's mainly a passive investment. You're basically believing in the management team, the key decision makers, and the direction of the company, and you simply feel it's a good investment, and maybe you get some rights and some say. But if making a majority investment, you're basically, I think, looking to have control. That's much more hands-on. If you're a hardcore investor, you may need to work closely with an HR and recruiter relative to bringing in top talent to take the company to another level, internal and external accounting, knowledge of marketing and sales, and then you may have more than one investment. That's more than a full-time job, which sounds a little bit like one of the things that a family office would do. Again, we can make this a multi-hour discussion about those topics, but minority and more passive and majority and more hands-on, a little bit of maybe from the legal and negotiating side from your perspective.
Sure. No, I think if you are making a majority investment, the negotiation position's a little easier. They likely need this investment, and it is a significant amount. Looks more like a private equity style investment, to where you may not have operational control, but you would have control provisions in the document that would require the investor consent over most material items. So, buying and selling of company assets, issuing more equity, anything that's considered material to the business, you as the investor would likely have some ability to block or allow per the documents. And that would be on the majority level. On the minority, it may be a position where you are not quite focused on some of those rights because of the level of the investment. So it may not be worth negotiating for, but we would still see some basic protections where they couldn't dissolve or change the business without your consent. And then certain rights, Angelo, that we talked about earlier, rights of first refusal, things like that, would not be uncommon even in a minority investment. So we still view those as worth asking for. Obviously, your leverage goes down a bit, and it may not be viable at that point, but we see those.
And I'm assuming you're really taking a look at the big picture, sometimes more diligence than others, depending on the business, the family, the amount invested, minority, majority. There's so many moving parts. But in today's COVID world, understanding that COVID is having a significant impact on many businesses, you also want to take a look at, has that company already took out a PPP? Did it look like good public policy for them to do that? Has it been a negative? Do they clearly understand the ramifications? Was it actually the best thing they should have done comparative to other sources? So I'm assuming there have been some adaptations with investors you're dealing with, understanding the government engagement through PPP, whether that was a good choice, not a good choice, or whether they should do it, if that's even still available. I'm not even sure. And really just taking a deeper look. And I don't know how deep you go with your investors, but do they clearly understand that COVID has impacted a significant amount of businesses, which maybe creates the distress and the opportunity to get in on better terms? I get it, but there must be some dynamic relative to COVID that you're engaging with your investors in.
Oh, exactly. No, I think that from a financial diligence perspective, the internal teams at our clients are actively looking at the numbers to see how COVID impacted the business and to see if the business is starting to recover, where it is in its life cycle with the impact of COVID. So they are crunching the numbers to that. On the PPP side, it's an interesting point. We've seen this come up a lot. There's always the question as to whether or not they were eligible. If they are eligible for PPP, are they then eligible for forgiveness? And what does that timeline look like for forgiveness? And you've got to factor that in. We've seen that come up a lot lately. And the other issue with PPP is you are typically not allowed to engage in certain transactions if you've taken out a PPP loan. So you need to look at those loan documents to make sure that you can do it. We had a transaction now that is signed but cannot close until the PPP forgiveness process is complete. And there's adjustments you can make to the agreement based on that. But it is something to think about and look at. And then if the PPP loan is not forgiven, how does that impact your analysis of the investment?
Yeah, I mean, there's other topics, a little off topic. Some of them we actually discussed last week with a guest, but some of the tax enhancements, whether it's a profitable capital gains investment or a loss for US-centric investors in companies that are C Corp, QSBS, I believe it's called, is one example, and other write-off opportunities. So depending on the investor, passive income, their other interests, I mean, again, and we spoke a little bit about this offline, having a really, really good tax person is incredibly important. And I know I say that almost as if, Angelo, of course we know that. Why do you have to reinforce that? I'm sorry. I mean, hundreds of families, I know thousands, and not that I may be a tax expert and know every nuance, but I would say most families can be more underwhelming than they think they are. And this goes back to the adage, I ask a friend for a dentist. Oh, like, who do you know who's a dentist? Well, my dentist is great. Great. What's their name? But how do you know your dentist is great? Did you go to dental school? Do you compare 13 different dentists every year and go to different dentists? You just assume because you're a smart person, every decision you make is great. So if you're using this orthopedist, this dentist, of course they're good. When in reality, we don't have enough knowledge 99% of the time to know a average from good to great, and great to exceptional. And these are all deep issues involved when investing in private companies.
No, that's right. I agree with that. And I think asking questions is where I come out. As an investor, just ask questions of your counsel and your advisors. I think it's important to run through, does this structure of an investment present issues with my overall financial strategy? Your tax planner should know that. On the legal end, just asking questions about what's important to you, just from a very basic level. These bullets are important to me. Do the documents allow me to have that? And it gives us a roadmap too. We've got our standard issues that we can point to, but it always helps for the actual investor to outline what's important.
And to our live participants, Travis is great. We encourage you to ask questions via the chat feature. I still have questions to go. I just wanted to give a reminder that we got some great investors on the Zoom now, and your questions would be appreciated. We also spoke, and my audience has heard me talk a little bit about this one specific family. I have not yet yet done a solo podcast about this. It's coming, about the value of significant family offices creating effectively their own internal VC. For a variety of reasons related to why they want to be a direct investor to begin with. Control being the big one, engagement of the next generation, more hands-on in the business building process than being an LP or a passive investor. So the one family that I've referenced a couple of times is, Angelo, we like that idea. We've been thinking about it and we think we're going to do it. We're going to involve some principal and family members in the family. We're going to bring in some outside talent and basically run it as a little bit of a satellite inside our family office. I'm like, that's great. So early stage, approximately 50 to 100,000 investments into like dozens of companies. We were thinking like 500 to 1,000. And I'm like, my God, you're the next like Dave McClure there. That's a lot of companies. How are you going to diligence? Well, these are early stage investments, very, very light diligence, but we believe most will fail. We have the stomach for it. You will maybe get some tax benefits from that, but we believe we're going to get very, very early stage in some unicorns, and that's going to make up for all of those that are bad. And they have some points, and I'm 90% on board. I just don't know if I agree with 500 to 1,000. But what would you say if you're approached by $1 billion family office? They want to create non-commercial, effectively their own internal VC. Maybe they even want to bring you on board. What would be things that a professional would look at? How committed is the family? What kind of capital are they going to put into it? And do they really have the stomach that possibly 8 out of 10 companies may go to nothing in a year or two?
Yeah, I think it's a great question. I think that number one, most families or investors have some comfort with financial reports and reading the financial statements. So I think that's, to me, the most important thing. And it's frankly a non-legal matter. So it's not something I get heavily involved in. But the initial blush is the company making money? Are what the founders of the business telling me, is that true? Is the company operating, generating cash flow? Is it doing the things that they're telling me? And that is generally looked at pretty quickly. So I think that's probably the first threshold issue. Angelo, to your point, it is a slippery slope with diligence. And I mentioned it on the first part of my call. You can get into a situation where you're spending a lot of man hours and a lot of legal or other third-party advisor time in looking at things. So I think it is an assessment of risk. Once you've looked at the financial statements, what's your risk tolerance? How deep do you want to go into these documents? I've found that most families and investors, after a few times through this, we have a standard due diligence checklist. Investors start to develop and create their own that maybe modifies that based on their experience. If there's a lot of deal flow like that, I think the investor will get comfortable with some of those initial steps, and then deciding on the investment, how deep do they want to go? And as a lawyer, we always recommend reading everything and going very deep. But again, there may be a financial or business reason why it may not make sense to go deep into 500 companies. You may just want to look at the documents briefly, run through major issues, and the financial commitment may not be big enough to warrant that.
No, actually, in that example, they would bring someone legal in-house as well as more of a investing experts, so probably 2 outside professionals plus some level of family engagement. But yeah, if they're going to be looking to make 500 to 1,000 direct investments, even with an internal person that's legal, it's again, and Dave McClure, who's a great investor and is a member of Family Office Association, he's not on today's call as a ultra high net worth individual. You're looking at the financials, you're looking at the big picture vision, the deck, but you can't do deep diligence on that many 50 to 100,000 investments if you're $1 billion family. There's no mathematical sense to that. It's a volume play.
Right. But I still think that, and again, it really will come down. It's kind of the 10,000 hours example from Gladwell. Through your deal experience, you'll realize as a family and as an investor what's important. And I think you can protect yourself with quality documents that the company should disclose things to you If you've got a quality set of documents, the need to do a heavy deep dive and diligence may be lessened.
Right.
But you do need to at least have that quality set of documents because you can then work through any issues quickly because they should, if you've got a quality set of documents, issues should be disclosed.
Well, what I would say, Travis, is that internal attorney, even if they do 500, not 1,000, he or she is going to be really busy.
Yeah, no, correct. 100%.
Even if it is relatively light diligence.
No, you're right.
A little bit of a twist on that, and I've spoken a little bit about this in my tax and wealth preservation conversations, both in podcasting with my members and some of my consulting. I've also been fascinated by families creating more of a commercial entity where they're a GP, they're potentially looking for LPs. And I know it's not going to be your core area of focus, but the benefits of carry, the tax advantages, and the fact that 2 and 20 is not such a bad business, assuming you're good at what you do and you really understand, though, you're opening up your kitchen to kind of be in a restaurant. And that means regulators and a lot more regulatory and oversight than if you're doing it just internally. And depending on what happens with the elections and the Democrats and all that, some of these amazing tax advantages may blow up in smoke. They may go away. But in theory, for a family really looking diversely at a variety of different interests and tax enhancements, I find that to be an interesting strategy. I'm not sure if it's something you want to comment about, but I'm fascinated by it.
No, I think the model comes up really more in private equity than we've seen in family office or VC, because typically our families or VCs are, well, frankly, it may come up in VC as well, but family office is probably more rare. I mean, we don't generally see families set up entities or funds with that 2 and 20 type structure or a carry structure. You could see that, but we see it more on the PE VC side. And what you're alluding to would be the beneficial tax treatment of a carry. A carry would be a percentage on profits above the investment. So you may, as a fund organizer, receive 2% of profit above the investment amount, and then that could be distributed out to you on a lower tax rate than ordinary income. And Angela, you've touched on it. Unclear how long that will last. It's been in the crosshairs for a long time. I seem to think even Trump in his first run for president that was in his crosshairs a bit. So I do think that people continue to look at that. Biden has come out and said they want to raise taxes on those types of structure. So time will tell, but that's the general framework of it.
And it's not spoken about too much by some of the great legal firms, including yours, that are active in the community. And I'll leave it to you in terms of how you want to articulate it. But you're at one of the world's most prominent firms, DLA Piper. They have tremendous access from the investors to deal flow to entrepreneurs. Many of the top legal firms have set up internal people, and sometimes not even really charging, just doing a benefit to their current relationships, helping to share matching A with B. Is that something that yourself or DLA Piper gets involved in on private transactions?
We do, and it's interesting you mentioned that. So, one of the reasons I'm at DLA is the size of the firm and the deals that we see. I mentioned at the beginning of the call, our deal volume is depending on the rankings, and rankings are just that, rankings by third parties, but we're in the top 3 in the world in terms of the amount of deals we see, the dollar value of those deals. And what that means for us is hopefully we're on the cutting edge of market trends. And if there's ever an issue that comes up through our internal network, we've seen it. So it's nice to be able to have those resources when you're doing complex or creative deals. And that's on a worldwide basis too. So what may be market here may not be market in another jurisdiction in the world. And we've got some of those offices worldwide to help with that. So that's the benefit of being at a firm of our size, and we're able to bring that to our clients. On the, and I think I'm trying to think the best way to answer. And so, Angelo, on your question on on terms. Maybe re-ask that again. I want to make sure I address it the right
Well, that
way.
was less specifically on terms and simply more on matching deal flow and opportunity, that there's just multiple sources now, that if families or the other party just put a little bit more time and effort into, I don't think getting deal flow is going to be much of a problem. It's out there.
Yeah, no, I think so. Helping families, a lot of our family office clients come to me a few times a year looking, for deals. So I've got personally, I've got, if I see something come across my desk, I usually send it to the handful of families that have asked me to do that, because they're actively trying to see things that may not ordinarily come across their desk. We also, and maybe this is what you were alluding to earlier, we also have a pretty unique program in our Bay Area offices that, it's for our national offices, but it's based in the Bay Area. And it's a former Goldman Sachs banker that we house there. And he helps to put together lists of clients that are looking for more deal flow. And then he helps match quality companies that have been vetted to some of our clients that are actively looking at deals. So, and it's nice because he usually does a baseline level of review to make sure it's fitting to pass on to clients. So anything that comes through me, I pass on, and then we can always put through to our internal network that helps put clients in touch with investment opportunities.
Yes, that is what I meant. And I wasn't sure of that specific person. Obviously, he sounds very qualified. And of course, in Silicon Valley, the Bay Area, what else would I expect?
Yeah, no, he's fantastic. We actually had him out. In fact, we've talked about, I try to have him out at one of our offices for an event at least every 6 months, and just to meet companies and investors. Obviously, COVID's changed that, so we may not do that in the short term, but we try to do that throughout our regions.
And we are getting some questions. I'm going to read them off now. We'll start with the first one from Chris Ray. Are there other faults that you see investors make other than the documents and tax? Where do they stumble?
Yeah, good question. I think that the biggest issue is financials. So, and again, this is kind of takes away from my importance, frankly, but to me, the biggest issue is financials. Is the investor comfortable with the financial statements? Do they have a third-party advisor that looks at those? Whatever that is, the investor needs to be comfortable that the financials are as what they're purported to be. So are they making money? Are they doing the things that were pitched to them? And do the numbers hold together? So I think that, to me, is the biggest thing. And
well, let's dive a little bit into that. So, and this is going to be more applicable to small companies. When they're bigger, you're probably going to want some level of auditing and a much deeper dive. But at a relatively light level, okay, I get profit and loss, I get this, I get that, but I don't really know if it's legit. And again, if I'm making so many investments, maybe I just have certain algorithms or a gut feel as if that's a good thing. But a little deeper than that would be to say, okay, at least could I see 12 months bank statements so I can match up top line? If I'm able to match up top line, then yeah, you may get creative on your accountant with bringing down your net, but I could kind of make 2 + 2 = 4. But if the top line is wrong or you're lying to me, then everything falls apart.
Right. Well, and tax returns, so not only
yeah.
issues with all those, you're going to have access to tax returns. And usually we'd want to see at least 3 years tax returns. So those numbers should all hold together or be understandable as to why they don't. So that would kind of be my number one issue. That's usually done pre-me. That would be something as a threshold matter before anyone calls me to engage me to look at documents. So when I come in, they're usually comfortable with the numbers. And then, to your point, Angelo, the accuracy all gets covered in my documents. So are the financials that were given to us, are they accurate? If there was an audit done, was it done in accordance with GAAP? All of those things are protected by the documents. So we should have a nice document that protects you, that in the event something wasn't true or it was simply inaccurate, you'd have rights through the agreement, and that's negotiated. Do you get some portion of money back? Do you have a breach? All of those types of things can go on. So that would be the importance of the documents. No, I think once you get comfortable with the financials, are there any particular issues we're worried about other than tax? I think, frankly, no, just making sure that you understand, every business is a little bit different. We've done some business, maybe the most important thing may be contracts that business may have signed with other third parties. So if that's a particular issue, we'd want to see those contracts to make sure that our investment doesn't somehow invalidate the agreement. So it really is a case-by-case situation. But to me, it would be financials. Do you have good documents? Do they say what they should say? Does the cap table hold together? And have you looked at the tax angles of the investment?
And another question that came in, we did discuss this, but maybe it's more of a comment he's making, but feel free to expand, Travis. He goes, please expand your thoughts on dilution. Isn't some better than none?
Can be, certainly can be. I think if there's a business where you got in at a lower valuation and the business is now doing an offering at a much higher valuation, you're diluted, but by virtue of the value of the equity, you may be seeing an increase in the value of your investment as a result of this subsequent investment. So dilution in that situation could be good. The party coming in could add a lot of value outside of the dollars. It could be a strategic investor, could be a VC with good relationships and contacts that are going to drive an exit. So that could warrant dilution. But it's something to think about, and look, most early stage investments are going to be subject to dilution. It is extremely rare to get a dilution protection. So you just need to, as an investor, need to know what are your rights associated with a future deal. Do you have an approval right? Do you have the do you have the leverage to ask for such a right? But no, it's a great question. And again, certain dilution could be welcome. I mean, it could be a very well-known VC that you'd love to have in as a partner in this because their track record.
I mean, each private deal is different. So I don't know if I want to get too deep into this rabbit hole, but there may be investors that look at something where they could hopefully impact the top line, revenues, et cetera, and have a chance to participate in that growth. So, and again, it's probably as much art and science, but you could structure deals that do verify the top line above a specific floor. And as that goes up, maybe there's a percentage of that goes to the investor. To make it more complicated, do you want to talk a little bit about how some negotiations involve the very complex field of profits interest?
Sure. So all of this is negotiable. I mean, the good news with these private investments, if it is a VC style investment, most sophisticated companies or VC investors do look to those NVCA forms that I referenced earlier. Those are kind of the quote unquote market standard. So that will show you kind of where the starting point is. But at the end of the day, every investor and every company has the ability to negotiate its individual deal. So that can go from, where we've talked earlier about voting rights, investor protections, whether it's dilutable or not, board seat, all of those things are case by case. How your investment is repaid, through a waterfall is also negotiable. Generally we'll see, there may be a preferred percentage that's paid if there's cash flow, and then a return of the capital invested. And then it could be pro rata. There may be a carry involved somewhere. Again, it's really individual, but that's generally what we'd see. I think that's, I think, and I think there was one other piece to
the profits interest part.
Profits interest. Yeah. Now profits interest, we generally wouldn't see it if you could see it, I guess, on the capital side. but it would be more of kind of an internal incentive to current employees, or maybe a return for service. So what might happen is, in the reference to profits interest confuse a lot of folks, and it is a little complicated, but the easiest analogy is options. They work just like an option, which is you get a right to buy in and get a percentage of the company at a set valuation, which should be the current market value. So it works just like an option. You've got an option to purchase company stock at X price. And there's a tax incentive to that. If you're granting profits interests, the holder of the profits interest won't realize any tax issues until down the road. So there's a potential benefit to the holder of the interest.
Travis, this has been fantastic. I really enjoyed it. For those that would like to learn more about you and your practice, and whether they're an entrepreneur that may need representation or an investor, how could they learn more about you and reach out?
Yeah, no, definitely. Thank you. And you can find me at DLA Piper, again, Travis Leach, Leach, and our website. If you look up DLA Piper, you'll find it. My email is travis.leach@dlapiper.com. Happy to answer any follow-up questions.
That's fantastic. And Travis and the firm are wonderful. It's a pleasure to have them on today, and very insightful. Look forward to having you back again in the future, because there's so much to discuss about this great topic. Everyone, I'm Angelo Robles, the host of the Angelo Robles Podcast and founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their single family offices. We do a significant amount of original proprietary content, host global programming. Now it's digital, but we're doing hundreds of them every year, and deeper dives than normally at the quick pace of coming and going at a physical event, including the recording and the recap. So there actually are advantages, including on your time and efficiency, much, much greater than physical events. We also provide a level of consulting on creating or reinventing, I guess you could say, adapting your family office. So take a chance to learn more about us. Our website is familyofficeassociation.com. My direct email is angelo@familyofficeassociation.com. We're extremely active as well on social media. Go and subscribe to our YouTube channel. And our channel is a great name for what we do. It's very simple. It simply is Family Office, and a fair amount lately, especially, of our content and some of our interviews are simply up on there as well. Everyone, thank you so much. Travis, thank you as well.
Thank you.
Pleasure. Thank you, everyone.